Did you know that the best companies often emerge in down markets where money is scarce and innovation thrives? In this episode, Marc Penkala reveals the contrarian strategies that turn challenges into opportunities in venture capital. But here's the twist. Most are too focused on potential pitfalls, missing out on the moves that could lead to extraordinary success. The fear of failure can be paralyzing, but real progress happens when risk is met head on. Imagine this. The deal everyone's excited about might be the very one to avoid. Marc Penkala explains why outsized returns often come from taking the road less traveled, and why European startups need to shift their sights from millions to billions.
The awkward thing about venture capital is, and when I have speeches or try to explain to someone, just imagine you're a doctor, a lawyer, a pilot, or any of like these very, very important jobs. Do you think you're going to be successful if you're wrong most of the time? And everybody says, this is the greatest deal in the world. You should not do the deal. Very simple. Why? The moment this happens, you literally have to stop investing because the tourists arrived. We see the best companies being created in venture capital are created in down markets.
Marc Penkala, the force behind Altitude Venture, Europe's first SME tech fund, offers a fresh perspective on what it takes to succeed in venture capital. With extensive experience both as an entrepreneur and an investor, Marc is pushing the boundaries of European startups, challenging them to think bigger and aim higher. Altitude Ventures is at the forefront, driving innovation by backing companies ready to break out of the traditional mold. In this episode, you will discover why European startups need to shift their focus from millions to billions and the mindset that's holding them back. How to spot when the market is flooded with tourist investors and why that's a sign to proceed with caution. The vital role of failure in achieving long-term success in venture capital, and how taking calculated risks can lead to remarkable returns. Before this episode starts, remember to subscribe, comment, and share. Your support helps deliver more valuable content like this. Now, get ready to dive into a conversation that could transform the way you think about venture capital and entrepreneurship. Don't miss this in-depth discussion. The insights Marc shares could be the turning point in your approach to investing and building successful companies. Watch the full episode to uncover strategies that thrive in even the toughest markets. Marc, it's absolutely fantastic to see you. How is life in Berlin these days?
Lovely. Quick, fast, lots of things to do. I'm in the middle of the move. We are raising a fund. We're investing into startups. I have a very active little kid, so I can't complain of not being busy. But overall, most of the things I'm doing on a daily basis, I've been deciding by myself to do. Mm-hmm. So life is just doing great.
You have a lot on your plate, it looks like. I mean, you have a kid, you run two funds, if I saw it correctly. Why did you decide to start two funds?
It would be lovely if it would be two funds, and it would be way too much for one person to manage. It's not two funds. The one is just my angel vehicle, where I've done roughly 30 angel investments and some fund investments out of. And the other one is a real professional fund. So the one is just a vehicle for myself. The other one is a real fund structured here in Germany, and which is consuming probably 150% of my overall capacity. And it's the only baby after my son I'm really taking care of at the moment.
That's great. I was just smiling because you said it's just 30 investments on the angel vehicle. It's quite impressive.
Of course.
What I would like to hear from you, your journey to becoming a VC. What was your route to the venture world?
Yeah, I always try to explain it in a very simple manner. For me, my route into venture capital felt like a paid executive MBA into venture capital. Why? Because looking at what you would cover in a typical MBA, you get a very holistic view of the whole landscape of what there's out there in possibilities. And that's exactly what I did. I started as an entrepreneur. I built several companies. I sold one. I bankrupted one. One is still alive, doing very well, is very profitable. From there, I kind of moved over to the evil side with a very simple thesis, to be fair. My thesis was, in order to become a better entrepreneur, I need to understand how VCs operate, to understand how they think, how they evaluate, why they invest, how they invest. And by just having that knowledge, that implied to me that if I build a company, I can tailor exactly what I'm building towards venture capital. So I actually joined a VC in Switzerland roughly 12 years ago. And there I literally learned everything bottom up, how to invest early stage. I did global venture development. I've been structuring venture studios and company building infrastructures. And I've been working with and structuring funds around the globe. And this gives me a very broad set of what's possible. So I kind of sneaked in all these little sub-segments of venture capital. And while I've been doing that, obviously you get the hybris. If I can do this as a VC, I can do this as an angel. And that's the vehicle I was talking about earlier. So I created my own little angel vehicle because I always had the feeling if I want to be a successful angel, I have to have a brand. So ever since I've been doing like roughly 30 investments and mainly around the globe. All of them have one thing in common. They're all early stage. They're early bets on founders and things where I had like strong conviction that they could work out. And after I left my former position, I started working with many funds and actually helped them as a commercial advisor to structure the funds. So I took all the learnings from being a VC, being an angel, being an entrepreneur, and pooled them into, hey, I can help you to actually build a fund, not only from a legal point of view, but rather from a commercial point of view. Like, how do you actually build the thesis? How do you validate the thesis? How do you actually wrap this and put this in a deck and sell it to LPs? And how do you actually build the underlying model, the fund model, and everything around it to make whole sense of what you're doing? And I think looking back, all this actually helps me to run my own fund. It's always nice to be on the sideline, explain to other people what they should do as a consultant, but it's a complete different thing when you do it by yourself, because you're going to expose yourself to a different type of risk, going to expose yourself to a different type of decision taking. And I think my story to get to that point actually helped me to master this in a proper manner.
That's a great story. That's a great story. Absolutely believe that it's, let's say, good assets to have both experiences, one as an entrepreneur and the other one as an investor. And I think also the third one as a coach is pretty helpful for investments. Let's start with the beginning of your journey, entrepreneurship. In which area did you operate?
When I started my very first company, I was 17. I was very young. I was naive. I had absolutely no idea. And maybe that was my biggest and strongest asset, having absolutely no idea. I actually built a company with my brother in the fashion industry. It was non-technical. It was not the time where the internet was up and running in the way we know it today. So that's, it's over 20 years ago, and I feel very old actually about it. And we actually started to buy fashion, high-end fashion, and actually sell it to people. And there was the time before eBay was eBay. It was Zalando here back in Germany. And we learned one thing very quickly: it doesn't scale. If you buy pieces and then sell them, you have a nice margin. So we said, okay, maybe we should consider thinking about selling in buckets. So we buy a whole collection and then sell it to somebody. You have a lower margin, but you can flip it easier and faster. So it made more sense for us. So out of this actual company, what evolved out of it, we actually created a store. We had created a wholesale, and we happened to sell that first year of university. And I made two very important learnings at that point. A, I was lucky, not smart. That actually makes you humble. That's very important. And B, I really understood that I have to understand the basic fundamentals in business in order to make a better business. And that's basically what I did. My second company, I was like a little more advanced. It was end of my university time. And I first time got in touch with venture capital, and I built a company which was in the SaaS space. And we did a BI solution for coupon sales marketing. So the overall aim was, it was more or less the counter product to Groupon back in the days. Groupon said, hey, look, you can just make like a coupon or like an offering on our platform. This is the terms, you have to take them. And we said, no, actually, it's stupid. What we want to give to merchants is the ability throughout the SaaS solution to create sales activities and coupons, distribute them over platforms, and then actually learn who their customers are to retarget them. Fast forward didn't work. We raised quite some money. I did 4 years of learning, and somebody else paid for it, and I successfully bankrupted that company.
One more question. Which year was that? In what year?
2011.
2011. Okay. Okay.
And I learned a lot, and major take for me was exactly like I kind of sketched earlier. I probably have to understand how VCs work, because the next company I'm going to build, I will need that knowledge. So interestingly, the partner I'm running Altitude with today, Ingo, was one of my angels, and he was investment manager of Mountain Partners, who invested in that company. So I lost his money, and I lost the money from him managing it for the VC we've been working with, and that's how we actually met. And fast forwarding many years into the future, well, we worked together. We were happy. We rebuilt the fund. So maybe it was a coincidence, maybe it was luck, but the outcome was actually great. So I do believe ever since in serendipity. So sometimes you find something without looking for it. And the third company, I actually went back to fundamentals, non-technical company, body leasing in the train driver sector. I did this jointly with my brother, another co-founder, and this company here again, without VC, doing fantastically well, very profitable. And I think at the end of the day, everybody has to find the right way into entrepreneurship. VC is not the only way. Having a company and getting it funded can be bootstrapped, it can be cash flow based company, and you can be equally happy or even with a better outcome, considering dilutions, considering fundraising, all the headache you're going to go through as an entrepreneur.
That's a great story. That's a great story. So basically, about the German version of Gary Vaynerchuk 20 years ago, flipping you flipped fashion, basically, if I understood you right, over the internet, Gary Vaynerchuk wine, and
yeah, exactly.
And then moved on. What was your biggest learning as an entrepreneur?
Failure is the biggest success. So I think there's many types of entrepreneurs out there. There's some entrepreneurs who are very lucky in the beginning, and they overestimate how smart they are, and they've just been lucky. So VC as well as entrepreneurship is a lot about timing. So thinking about Groupon, thinking about Facebook, thinking about many companies. These companies have been there before. They didn't work because it was not the right market for these companies. And some people just have the right timing. Maybe they're even smart and they're lucky to sell a company. And a small fraction of them, they get this hybris. Hey, I was so smart, I can do this again. And they realize, well, they can't. There's a certain subset of people who can and build multiple companies, and they're constantly successful, have a very high hit rate. But to be very fair, the likelihood that you build multiple companies and actually sell them and build like great sustainable businesses is not very high. So for me, looking back, I think timing is a very important aspect I learned, and failure is the biggest success. That's looking at all the big failures in my life. Many of them turned into very great things, such as I failed with a company I was running, but one of the investors, I actually happened to work with him for over 10 years, and now we built a fund together. So if I wouldn't have failed, maybe I would have done something very differently. And so it's a matter of perspective, how you perceive failure and what you do out of it. And we have this weird mentality here in Germany, and it's very contrary to how the US works, that failure is something bad. Oh, you failed. It didn't work. You're not smart enough. You're not good enough. It's like, no, totally not. You have to fail. And the principle of resilience, how often you actually get up again and do it again, that's important. And entrepreneurship, nobody will ask you how often you failed. When you have this one home run, it's totally fine and totally paid off. As long as you learn and don't do the same mistake twice.
We were talking about failure culture, and I totally agree to what you said, that it's very rare that entrepreneurs get it right on their first shot. And I think it was Monish Paprai, it's an investor from India, who resembles the style of Warren Buffett, said, when you look at the corporate world, 90% of startups are gone after 3 years. And 10% the survivors, only a few make it to the public markets. And when you look at the companies on the public market, I mean, 5 years, 10 years, 15 years, 20 years, after 20 years, almost all companies are gone. So I think entrepreneurship is basically expecting failure, expecting not working, expecting that at some point in time, it might be wise to sell the company, And also, when the company goes public, it might also be wise to not move with the company and start something new. And I think I totally agree also in Austria here. It's very rare that people like this idea of failing. And entrepreneurship is basically 10 straws, you pull one and you have a chance of 10% of pulling the right one. And there is only one Elon Musk. But in your story, what I find intriguing is you didn't give up. You kept trying. You created multiple successes and similar to Elon Musk, and then decided to leave entrepreneurship and move into the venture world. How was the transition from one side of the negotiation table to the other side?
As I said, my main idea back then was I would really like to understand how VCs work, not only to build better companies which are tailored for venture capital, but moreover to better understand how they invest and why they invest into companies. And as I said, my thesis back then had a small flaw. It didn't take me 1 year, it took me a decade to actually learn how they operate, because there's so many facets and different ways on how to do VC. You can be an angel, you can be a micro VC, you can be growth stage VC, you can be a secondary VC, and all of them have a very different mindset how to approach investing. So what kept me thrilled about this whole industry is I was allowed to invest globally. Markets behave differently. I was allowed to invest across different times. We had great up markets where there's just unlimited money for like stupid ideas. And now we're in a different market where there's not unlimited money and only the great ideas get money. And the default mindset or default alive mindset is more important, and capital efficiency is more important. So for me, the transition into venture capital and staying in venture capital was the most natural thing. And referring back to failure, it's a very important component investing and working with entrepreneurs on a daily basis. If I would have never built a company, how can I authentically sell to an entrepreneur I can help you? I never walked in your shoes. I never raised a single dollar. I never failed. I never succeeded. Like, you will always be pointed out like, you don't understand. You're giving me money, but you have not done this. You have not experienced this. You don't know how the pressure is. And if you have actually experienced that yourself, well, if somebody's just finger pointing and you're like, no, you don't understand. It's like, no, I do. I did this. I bankrupted a company. I lost money from others. And yes, I did. I actually built a company and I sold it. I know the process. And I know the ups and downs and how challenging it is on a mental mind space thing. So I think it makes you simply more authentic, and founders actually listen to you if you can tell them from real war stories. If you just always have been on the sideline, yeah, it's like a doctor who never done a surgery. It's nice that you know it all on paper, but like in a moment of a crunch, it's not going to be super helpful. So I think it was very valuable to fail and to succeed along the way as an entrepreneur to become a better VC. And I think that's you've seen it in a past 10 years, the rise of operational VCs, ex-founders, exited founders, and entrepreneurs actually becoming VCs. Are they the best VCs? I don't know. You still have to learn how to do VC, but you obviously understand how to actually build companies, and you know what kind of mistakes you have done, and you know how long it takes to iterate. And that's very valuable knowledge to assess a company in order to derive whether this company can be successful at some point.
Yeah, this is a big question. Do you need to know how to drive a Formula One race car to coach Formula One drivers? What's your take on that?
I wouldn't say you need it. I would say it helps. So let me put it this way. Just imagine you are a doctor, and you have always been having patients and which are kids. Can you be an equally good doctor for grown-ups? Probably not. So it behaves very similar when you think about like operators which turned VCs. You're a great founder, you know how to build companies, and maybe you even succeeded and sold the company, even maybe like in an outlier case. It doesn't necessarily make you a great VC. It makes you get great entrepreneur who turned VC. It doesn't make you a great VC. So venture capital, and especially whenever we onboarded new employees in my former job, or like even in our fund Altitude, one thing you can't do in venture capital is fast track knowledge. It's all about experience, seeing different cycles in the market, seeing how things behave, knowing certain methods, knowing how to actually keep companies alive, and actually having the experience to say, okay, I'm going to fund you again I'm going to pull the plug and actually write this company off. This is something you don't learn in paper. This is something you don't learn as an entrepreneur. You have to do it. And the awkward thing about venture capital is, and when I have speeches or try to explain to someone, just imagine you're a doctor, a lawyer, a pilot, or any of like these very, very important jobs. Do you think you're going to be successful if you're wrong most of the time? No, you're going to lose your job immediately. If you're a pilot, you crash the plane, you lose your job. If you're a doctor and your patients keep on dying, well, you lose your job. If you're a lawyer and you never win a lawsuit, you lose your job. As a VC, you're more often wrong than right. And there's an inverse correlation between being wrong and being successful. So the more often you're wrong, the higher the actual output of your fund. And this is something you don't learn by knowing it, learn by experience. So great entrepreneurs are not necessarily great fund managers. They can become great fund managers, but it still takes time.
How is the emotional side of a VC? How do you experience that?
It's funny when I speak to founders, they think they have the hardest life, and they surely do have. It's tense and emotionally it's a roller coaster, because like whenever we raise a round, founders are super excited and happy, and I was kind of remind them like, look, after the race is before the race. You're going to be out anytime soon. The thing about venture capital is it's super easy to invest. There's one downside. It takes very long to see if that company is going to work. Can be 6 months, can be 10 years. Many companies of which I thought these are going to be the outliers in my portfolio turned out to die. And the companies where I thought, this is not going to work, turned out to be the ones which worked very well. So here again, you're more often wrong than you're right. Being VC, the toughest part is not taking the decision to invest. The toughest part is taking the decision to divest. So if a company is not doing well, do you keep it alive because you still have the idea or feeling this can be something? Or do you stop funding it? And this will determine whether the company is going to be successful. So pulling the plug, knowing when to leave the cap table, knowing when to exit, knowing when to refund, these are the tough questions. Investing is the easiest one. That's the first part of the journey. So what most entrepreneurs think is like, hey, it's so easy. You just manage money. You invest into companies and you lean back and sit and wait. Yes, no, you don't. You have a portfolio of 30 or 50 companies. Just imagine you run your second or third fund generation. You're sitting on a portfolio of 50 to 100 companies, which you kind of try to actively manage. So if you just have these 50 companies, you will likely have 10, 20 funding rounds per year, where you have to decide, do I participate? I don't participate. Company's dying. You have to manage this. You sit on boards. So you're literally constantly a firefighter. And one thing which people try to neglect as a founder, or most people thinking about fund managers, when you raise an emergent fund, 30 to 50 million, you can compare it to raising a pre-seed round of 30 to 50 million. Have you ever tried that? That's not easy. You have the same challenge. People don't believe you can do it. You don't have the track record, don't have the rash. You have to speak to a lot of people so they give you money. It's not a walk in the park. And it takes a lot of endurance to actually go to the valley of tears to get to the point. And here again, and we see everybody looks at successes. Nobody looks how people got to that point. 10 years, 5 years, 15 years of prior experience to actually just start. So after all, I would say it's equally tough, even though it seems like a shiny, nice job to just sit around and manage money and throw it into companies.
Yeah, it has a lot of facets. I mean, both sides, founders, entrepreneurs, and VCs. You mentioned sales, selling, getting people to invest in funds or companies. I think people need to learn that it takes a few hundred calls until you get to a meeting. And it's also the expectations that I see very often on the market is, Christian, you know so many people, you know so many VCs, just introduce us and in 2 weeks we have the money then on our bank account and we give you something for that. And it doesn't work that way. It doesn't work that way. Can we dive a little bit deeper into a sales process of a venture fund and also your perspective as an entrepreneur, how much effort and time it really takes to get a round closed?
Yeah. So as an entrepreneur, as a fund?
Let's start with entrepreneur and then move on to the fund so that people see both sides and what the reality is and not the shiny knight in white armor who gets everything done in 2 weeks.
Yeah, totally. So, well, as an entrepreneur, there's multiple sets of entrepreneurs. The experienced one, the serial entrepreneur who's done it before, he knows how to do it, he knows to whom to speak to. So the more tailored you are, the more you know your customer, which is your investor, the better. So there's first-time entrepreneurs who just go out and say, I'm going to speak to 100 VCs, neglecting whether they invest in the stage, neglecting whether they're active in that geo, in that industry, looking for these kind of business models. So just going broad is the worst thing you can do. Why? Because you're wasting your time. Your time is the limiting factor. You have X amount of hours which you can work. And if you spend them on the wrong targets, it's a waste of time, right? So the farther you go, the more you understand, well, I have to be very tailored, very specific. Who's investing? Who's my target? And the hit rate is just going to increase. So if I know, hey, these 50 VCs do early stage in Germany in SaaS companies or B2B, B2C, whatever you want to classify yourself in, the likelihood that you're going to find one who might be funding you is simply higher. But if you take 100 and 60 of them is B2C, well, you still wrote 100 emails, but 60 would have not been necessary. So raising funds is A, very strategic. B, you really have to know what to raise, how to raise, and from whom to raise. And C, moreover, you really have to understand how to address these people. Thinking about going to professional VCs, they get 10, 20 deals a day opportunities. They pass on 19 immediately, one they're going to look at. And this accumulates over the years. So they're going to look at maybe 100 deals and they're going to end up doing 5 to 10 deals if they're a very active investor. So you have to consider how to get the attention. And the only golden way is a warm introduction. So looking at my own deal flow, if people just coldly approach me, the only chance that I get back to them is this deal is so appealing that I actually really want to learn more. The same deal would have a 10 times higher likelihood that I just pick up my phone and say, let's jump on a call if somebody I know refers me to that founder. So the golden way is go into your network, see who can give you warm access to angels, to founders, to other founders, to VCs, and so on. So you actually have the first entry throughout that, and not a cold email approach, just pinging somebody on LinkedIn or via email. And as an entrepreneur, be very mindful about how much you raise on which valuation and what's realistic with the traction you have at that point. So moving this over to a VC, I wouldn't say it's completely different, but here again, you have to know who's investing for us to an emergent fund. That's important. So why would I go to an institutional investor knowing they invest 10 million checks into established funds? Well, maybe it's nice to speak to them, but it's not going to happen. And here again, it's slightly different on when you raise a fund or funds as an entrepreneur, you raise one chunk usually. So you raise a 500K or a million or whatsoever. As a VC, you raise in steps. So you have a pre-market closing, you have a first closing, second closing, or rolling closings, and then a final closing. So you kind of have a time span of 6 to 18 months where you actually raise the whole fund. But you raise it in small steps. So you raise the first closing, you take that money, you invest, you have no blind pool, you show what you've done with the money, you excite other LPs, you go to them. What you usually do is you go slightly up the ladder. So you start with the low-hanging fruits, high net individuals, exited entrepreneurs, small family offices. Then you go next step, multiple family offices, fund of funds, more professional investors. And then you go at the end towards maybe institutional or governmental money. So EIF, KfW, or more institutional type of money, depending on the size of the fund and the type of the fund. So you have to be very mindful who you address when, whom and when. And raising money in VC is very much about relationship building. So it's not like you call somebody, hey, this is great. We have a fantastic idea. This is the thesis, and they're going to write you a blank check and say, just fill in the number. It's not happening. It's not in this market. So the reality is you have to feed them. Look, we started here. That's the thesis. Second call is, look, we have raised first checks. Third call is, look, we have first checks and we have done first investments. You have to show constant progress. You do this as well as a founder, but in VC raising from LPs, it's vital to do it. If you don't do it, if you're not good in relationship building confidence on the other side, you will simply fail in raising money. So yes, the process itself is slightly similar, but the magnitude on how to do it and the scope is very different.
Totally agree. I think this is one of the areas that is mostly neglected on both sides. Ventures are, say, emerging venture funds, and also founder side, it's relationship building and investor relations, in my opinion. You mentioned with the founders that warm introductions have a higher success chance or success rate than just cold emailing, but both takes time. You need also to get in touch with the right people. You got to know them. You got to brief them. I think a warm introduction can also be not very helpful for a mission if it's just someone on LinkedIn that you pinged briefly and say, hey, you know this VC, send my pitch deck to this VC, and then the guy says, okay, yeah, here. Doesn't help anyway.
Well, obviously this doesn't work, and I think I try to distinguish between like a sniper approach and a shotgun approach. Just go broad, and eventually you will hit something, or you're very precise as a sniper. You know, this an angel, this VC, they invest in this type of business I'm running, and then you ask for a warm introduction. So you just increase the likelihood that you A, get an answer, and B, have a likelihood that they actually invest. With a shotgun approach, you can literally get to the same result. It's just going to be more effort. You have to ping 100 people, and you have to maybe speak to many of them until they find out, no, it's absolutely nothing I'm interested in. So both can work. I'm just trying to say that you just increase the likelihood that it works better if you're more precise in like kind of ICPing your investor base.
I dissect it in my world in two stages. One is the investor relations stage, which is more, in my opinion, the shotgun approach. Just go broad, meet people to understand what they want, what they need, what drives them, and all this information that you mentioned, which stage, why do they invest, how do they invest, in which companies do they like to invest, what are their success stories, what are their failure stories. And when it then comes to raise funds, you can then turn sniper and say, okay, now I have these 1,000 contacts in my database. I've met 500 already. I know them. I know what they want. And out of these 500, 20 are perfect fit. And then you can just target them down. But I think also from the venture funds, I think this investor relations part is completely neglected still.
Absolutely. And as a founder, I mean, what you do is you send quarterly reports or monthly reports to do an update call here and there whenever something happens. As a VC, you're more active. You want to engage these because you want them to invest into your next fund as well. You want to feed them. You want to give them investment opportunities of your portfolio, but as well of like investments you have not done. Just because I'm not doing investment doesn't make it a bad investment. It just makes an investment which doesn't fit my thesis. But a family office or an active high net individual could be very interested in it because it falls in their ballpark. So investors relation as a VC, that's a complete different game compared to like a founder, because you stay on a journey with them for quite a while. You don't expect them or think, oh, these guys are going to invest in my next company. As a VC fund, yes, you do that. Absolutely. So you try to build that relationship and keep them tied to you in order to show them, hey, you betted on the right horse. And as a founder, yes, you want to do the same thing, but the intrinsic motivation is a different one.
That's a great point. Yeah, completely. Yeah, that's a great point. It's good to know. I think it's also worth keeping that in mind, investor relations, how that works. From your story, entrepreneur, venture fund, and then you decided to move one level up and support several venture funds in their fundraising approaches. What was your biggest learning in this time?
When I started thinking about how can I use my knowledge and help emerging fund managers to build their funds, I actually didn't do it by intention. It was rather I was leaving my job, and then I thought, okay, I'm going to look for a new job, and it will likely be in venture capital. So I'm going to speak to many venture capital funds. So while I was doing that, I realized all of them have the same approach building new funds. You go to a lawyer, you tell them, hey, look, I want to build a fund. They tell you, yeah, wire me 120K, and I'm going to help you. Doesn't work like this in reality, but so the narrative. So they help you on the legal side on, hey, you need a fund, you need a manco, you need a carry entity, you need this and this and that, and that's what you have to do. You have to go to the BaFin. So they actually cover that whole part. On the commercial side, it doesn't matter how smart you are. It doesn't matter how educated you are. The likelihood that you've built a fund before and know how to do it is zero. So what many mentors and advisors do for startups, I just thought, hey, I actually can do this for funds. And not necessarily on the legal side, because you have lawyers for that, not on the fund admin side, because you have fund admins for that, but on the commercial side. How do you actually build, and this is one core element of what I've been doing mainly, how do you build fund models? How do you make them viable and feasible? How do you actually build a deck which is compelling to sell? Hey, there's a match between the GPs and the thesis. How do you sell and set up your track record? So all the stuff you basically need, not only to get going, but as well to kind of wrap it and sell it to LPs. And interestingly, you have a bazillion questions along the way. And what's weird about venture capital is when you speak to other GPs, everybody will give you a small snippet of knowledge, but nobody will give you the whole picture because everyone thinks I have the secret sauce and it's going to tell you. Everybody's going to throw you one LP. You might going to speak to one hidden gem of knowledge, but they will not give you the full picture. And I said, actually, you can make a business out of that, giving the people the full picture. So I actually stumbled into that and actually ended up working with many funds. And my main motivation was I want to work with funds from different areas, early stage, later stage, primary, secondary funds, ICT, Web3, all across the board. Finding was, looking backward, I actually learned more than I gave away. Mm-hmm. The things I gave away were valuable for the people I worked with, but I kind of learned how to do it differently, why people approach challenges in a different way. Just because I do it this way doesn't mean it's the right way. It's just one option on how to do it. And this was amazing for me. That's why I decided to do it for multiple years, because your learning curve actually is very steep in the beginning, and you just get even better in doing that. And but at some point I woke up some morning and realized I'm a consultant, and I never envisioned to be a consultant. So I said, well, now it's maybe time to build my own fund.
How was that experience, waking up in the morning and say, I'm a consultant now?
Awful. I tell you why. It's like being an entrepreneur, working VC. It's the best job in the world. You have the steepest learning curve. You have different tasks and challenges every day, and the market is moving. So I really enjoyed the journey up to this point. And working as a gig economy worker for funds was great. I worked with incredibly smart people. Most of them were smarter than me. They just were lacking the specific knowledge on how to build funds. So I plugged my knowledge into that. But if you jump from gig to gig to gig to gig, you kind of lack the longer view. Like, it's okay, is this what I'm going to do for 20 years? And I realized, no, absolutely not. And then the morning I woke up, I was like, okay, that's the crossroad. Either I'm going to stay with this and I'm going to make a business out of that, or I'm just not going to do it and miss the opportunity to build my own fund. And that morning I just said, no, I don't want to miss that opportunity. I want to go back to the actual fundamentals, investing, working closely with founders, helping them, accelerating them, and investing, and not being the chilling sideline, helping other people to invest. And that's where I was very unfortunately lucky that I could join forces with a former colleague of mine, a good friend of mine, and actually build Altitude.
And you already burned his money, if I remember it right.
So. Yes, so I have nothing to lose anymore. And we have a joint portfolio together. We invested together as VCs. So I think we are way beyond that point that I actually happen to lose this money.
How many funds did you see in your time as a fund advisor?
How many I've seen, like deal flow wise, I've seen 200. It was interesting because it was a time around like 2021, 2022. So we were in an up market. Everybody thought I can build a fund. Lots of micro funds, solo GPs, and everybody literally started to build funds. I was in parallel. Carter came up, Bunch came up, lots of solutions on how to actually easily create funds on a legal or structural point of view. So what a time to be alive. I've seen incredible amount of fund decks. So here again, you just collect the data, see what's looking good, what's working well, what's not working well, and you can kind of derive your own actions. Funds I actively work with was roughly 20. Funds I really worked with over a longer period of time was 10. Mainly, you have a limited factor time, and the other one is you don't want to engage with everyone. If I see a fund, even though somebody wants to pay you and you think it's stupid, doesn't make sense, I wouldn't feel comfortable just charging people money to help them, knowing it's not going to work eventually. So I focus on the ones where I had high conviction that they will work out, and people just I wanted to work with. And I did think that's equally important, because at the end of the day, if you keep on working with people you don't like, it's not going to be too pleasant.
That's true. It's
as easy as that, yeah.
Yeah, being the CEO of your business and your own life is very important at the end of the day. Yeah. It's we are defined by the people. So I think there's this quote on the market, on the internet, that we are the average of the 5 people we spend the most time with. So it's really
And
key
it's
to
something
select wisely.
say.
Hmm?
And something I constantly say and I fully agree with. And that's why I try to be very mindful about who I spend my time with. Not sounding arrogant. It's not about being arrogant, but these people will sharpen you. You're going to be very similar to them. And I always add one thing is like, if you're the smartest person in the room, you're in the wrong room. So these 5 people are not the right people anymore. You might have to consider to kind of remove people and add new people. Doesn't mean you should remove long-term friends. That's not what I mean, but like professionally.
And I think this makes a huge difference also for venture VCs and also for entrepreneurs, having the talent to bringing the right people together, who form the right energy, and they can move super quick and super far and super fast compared to teams when you don't have this level of perception that you see, okay, these people don't work well together, and they just end up fighting and heckling over small minor things. You can easily get stuck with your team not moving forward.
I always believe as well, like being a fund manager as well, being an entrepreneur, a small leak can sink a great ship. So why do funds fail? Why do only 10-12% of first-time fundraise a second fund? What's the main reason why companies fail? Because the composition of the team is not right.
Yeah.
Business leaving, the other ones can't do it alone. So going on a journey, you might be very mindful on who you want to go on this journey with, because it's a journey which is going to be very stressful. So you might have to have people on board which can actually handle the heat. And we see that with lots of teams, and we say, hey, this is a great case. It's just the wrong team on this case. So we can't invest.
Yeah, and then you need to also be calm. I mean, 2 weeks to cash out sometimes happens in a company. And the worst thing that can happen is the CEO losing his nerves and starting panicking. When I look at your journey, I mean, you said that in the time 2020 to 2022, you saw about 200 funds. You worked with 20 funds, and you had close relationships with about 10 funds. It seemed to me, if I would have to find a comparison, it seems to me like the time when Steve Jobs tried to put another smartphone on the market, another mobile phone on the market. Why did you feel that although you saw this thriving market where a lot of new funds appeared with a lot of theses that, in your words, don't seem to work, the market is at the peak. Why did you think it was the right time to put another fund on the market?
It's a very good question. So looking at all the funds I worked with and looking at the market back in the days, I think you didn't even need a huge justification to be in the market. Why? Because the market was very liquid. So there was so much money in the market for funds as well as for startups that raising money was like not the issue. So you went out, you might have had some track record a little bit and to good idea, you could have raised funds as an entrepreneur and as a VC fund. So to be fair, looking at the macros, looking at the past 25 years of venture capital here in Europe, there's an interesting correlation. If there's lots of money in the market, TVPIs go down. If there's not that money in the market, TVPIs go up. Why? You become more mindful where to put your money. So fundraising becomes harder as a VC. Fundraising becomes harder as an entrepreneur. And that's because it's harder. It's just the top people raising. Quality is going up for funds and for entrepreneurs. In that market, what I found scary was I saw people raising money, founders as well as funds, where I said, wow, okay, people must have a lot of conviction that this is going to work, or there's a lot of dumb money. And this is one saying in venture capital, when the tourists arrive, you should leave. And this usually happens when the market is flooded with money. Angels investing into companies having no idea. LPs coming to the landscape because they think, hey, this is the new gold rush. I have absolutely no clue about venture capital, but let me put some money into funds and startups because I think this is cool, this is on vogue. So the moment this happens, you literally have to stop investing because the tourists arrived. And I don't mean this in an arrogant manner. It's just a very dangerous time because there's too much stupid money for not good ideas. And I remember the time very well, like when I looked at like the Q-commerce companies, and when I looked at the micromobility companies, I back then as an angel, I saw most of them decided to not invest because none of them worked. They were piggybacking on the idea that they can pull off the same thing as food delivery did. Hey, look, there's going to be 10 players. They're going to consolidate at some point. They're going to IPO. That happens. And people thought they can replicate this with roll-ups, with ratio models and Razor and stuff like this. They thought they can do it in micromobility, and they thought that they can do it with Q-commerce. Eventually, none of them worked. Leading to another point, VC is so much about timing, when to enter and when to leave. If you miss these 2 points, a good story of mine is I met an angel back then, and he said, dude, I have 10 angel investments. One of them was one of the first tickets in Tier and one of the first tickets in Gorillas. So I was like, okay, all right, dude, you are an outlier. If you have these 2 home runs in your portfolio, I don't even care what else you have in your portfolio because it's the magnitude of outliers in your portfolio. The rest doesn't matter. I said, you must be the smartest guy on earth. Well, he eventually didn't see a single dollar on either of them, even though he was the first investor. So timing is everything. And looking back and why we decided to go into a market which seemed saturated. Our first question before we started Altitude was, does Europe need the 2001st fund? And the answer was no, it doesn't. The second question was, if Europe needs the 2001st fund, how should it look like? So when we thought about what we want to build, we started about linking our expertise and track record to what we actually want to do. We looked at our track record. We deployed a little over 100 million early stage startups and looked at every deal. It was over 500 transactions. And we said 75% is in B2B. It's early stage and it's Europe. Okay, this is something we can explain to somebody that we have experience with. Then we looked at the VC market and we figured, all right, 80% of VC money is going into B2B. That's a crowded space. Then we looked at the 80% and we said, the majority of that is going into enterprise. Then we're like, okay, why is that? Then we looked at the nature of the funds, and most of these B2B funds going after the enterprise, 100 million plus funds. If you run a 100 million plus fund, the only way to make money is to invest, and every single investment has to have the potential to be a fund returner. So if you look at enterprise, first is total addressable market. It has to be big enough. And the second one is, based on that, you can derive a terminal value of this company at some point, and the possibility, can this return a fund? If you think about this, you realize, well, the only way to actually be successful in B2B is you have to go after enterprise. Otherwise, you can't return a 100 million fund. To give you a little glimpse of what returning a 100 million fund with a single asset means is, you have to enter that company in the pre-seed stage and return almost 200x on that company in order to return your whole fund. The likelihood of returning 200x on a single asset is 0.0001%. So either you build a portfolio of 10,000 companies, or you're a very good picker and you actually manage to pick higher up the curve. Both is difficult. So usually doesn't work out. So you have to be lucky. So there's a way on how to opt out. You enter a company pre-seed, then you actually do a follow-on in seed and maybe even a follow-on in Series A. So you can reduce the multiple to roughly 60, 70 on a blended view. That's how you return a fund. So going back to our story, we're like, all right, we're not going to raise a 100 million fund. So maybe we have to think about that our primary strategy aside of the positioning has to be the fund size. So we are eyeing after a 30 million fund, and thinking about that is like, if you want to return a 30 million fund, you don't need a 200x, you rather need 50x. And the terminal value of an exit has to be rather in the ballpark of 400 to 500 million. What does it mean? Think about a company where you actually have a 200x. That company is a $5 to $10 billion company or euro company. How many companies in Europe have you seen exited and created liquidity for the LPs? You can probably not name one. I can't either. So Europe doesn't have the market, even if you can create this paper value, to return this money. So our journey focused more on how can we enter the B2B market in an underserved sector. And for us, after looking at the market, there was a very quick learning. Well, 90% or over 90% of the market is SMEs. Then you have 5 plus something percent, which is mid-market, and then you have 1% enterprise. Why would I go after mid-market and enterprise if the SME market is completely underserved, even though it's a long tail? So we looked at the nature of this market and we figured, well, the market has many flaws, but there's certain subsets in the market which are really, really interesting. So what we learned along the way is not everything in SME tech works. So SME tech, like startups, creating digital solution for SMEs, that's SME tech for us. But there's a subset which works extremely well. And this subset is either verticalized solution, having a software solution for a specific vertical, or horizontal solution which have embeddedness, or something we call, it's a common term, many people don't know it though, is trifecta startups, where startups combine multiple business models. Good example is Get Your Guide. You have a marketplace, then you have a SaaS product on top, and then you have maybe a fintech solution. By combining, you can A, increase your margins, B, lifetime value, and C, you can reduce COGS. That's how you build these stellar great companies. And it's just one of them. And what we've seen in 2023, and this is due to the nature of the market, many founders said, "Ooh, VCs don't want to give me money unless I have traction, I'm default alive, I'm showing strong KPIs early on." So if you go after enterprise, the sales cycles are 12 to 18 months. So you raise money, you go out, and after 12 to 8 months, you go out again, and people ask you, "So what did you achieve?" And you say, "I have an LOI." It doesn't do the trick these days. So we looked at over 2,500 deals in 2023, and we realized by clustering it by cohorts on a monthly basis, the density of B2B startups going after SMEs first increased every month because you can create early traction. It's easier to sell, it's faster to sell, you can bring earlier proof points, and you can show even that you're profitable. And that triggered us a lot to say, okay, if we build a fund, our market gap is SMEs or startups serving SMEs with digital solutions. Because A, there's not too many VCs doing that. Actually, when we started, there was not a single one being SME first. The second one is all the B2B funds fund these companies after we fund them. So the big funds say we want to see industry or category leaders, or these companies going up market into enterprise. That's what we're betting on. Industry leaders, category leaders, other companies which build bread and butter business in SME and then go up market into enterprise. And the mindset of entrepreneurs changed, going after SME first. So the density of great companies evolving out of that just increased over time. And that was for us the perfect storm where we said, okay, this is what we have to do. We have to build a fund to cater the undigitalized SMEs in Europe. And the last component is surely how SMEs think. 20 years ago, everything was fine. Revenues were going up, margins were going up. It was a great party. Then at some point, COVID came. Supply chains were distressed. Then interest went up, or inflation went up, and then interest went up. And all of a sudden, all these SMEs find themselves in a position where things are not going that well anymore. So there's two options. Either I die or I change something. What's the way to change? Digitalize, automate, be more efficient, be more productive. What's the way to go? Technology. Why is it realistic to do it now or important to do it now? Very simple, because technology is at a different point. We have AI, ML, no-code solution, low-code solution, plug-and-play solutions. 10 years ago, this was not there. If you want to operate a software, you need somebody to operate it. These days, you just click a button and all of a sudden you're more efficient. And this is exactly what we're betting on, that the next wave in venture capital will be SME tech-driven and nothing else.
SME tech. In which year did you start your fund? So when was the birthday?
The birthday?
Your official birthday.
Well, we started early 23. That's when we went out. We observed the market. We sharpened our thesis. We prepared well. We started building our community, and we actively started investing end of last year.
So I assume you raised in the up market from 2020 to 2022?
2022, at the very end, was the tipping point where the market crumbled. So we actually started to go out when everyone was like, oh, we think the party's over.
How did you convince people to invest at this point? I mean, it was already the tipping point on the way down, basically.
As I said, I think it's one of the hardest things we have been doing. And it was not just us, it was everyone who went out in this market, because it was an awkward market. The established funds said, oh, we're not going to go out. It's not a good time to do so. So these people were not asking for money. There were some emerging managers which did go out. And but all the LPs said, oh, okay, well, First of all, I see all the corrections flying in my existing portfolios. B, I see that VCs are not acting. Everybody kept their money and said, okay, we're going to sit and wait and see where the market is going. And it was literally almost a dead year for fundraising for everyone, for startups and for VCs. So I think the only way to raise in this kind of market is existing relationships. So people in the network which you have been working with, you invested with them, they trust you and they bet on you. They don't bet on your fund. They literally don't care what you do. They say this person, this GP is a great GP, unattached of what they do, and that's why they give you money. So I think the hardest thing is to actually convince the first batch of people giving you money, because the second hardest thing is when you go out, everyone is like, hey, this is a smart thesis. This looks great. It makes all the sense in the world when you tell me about it. Can you show me deals? It's like, ha, you're funny. Money to deals. And then they say, well, what about you come back when you do deals? So you kind of need this flywheel to get going with the people from your closer bound, the inner network, who give you money so you execute or warehouse at least the first deals. Then you go back to these guys, say, look, I did the first deals. This is the thesis, this is the outcome, and this is what it's exciting us. And what was important or is important for us is you create excitement throughout deals. People buy into that you have the track record. People buy into that you're smart and you can actually pull this off. They see you have the structure, you created the fund. 2021, it would have been enough to raise a fund like this. 2023, 24, you can have the great track record. You can be the smartest person in the world. They want to see, please raise some money first from others, then show me what you have done, and then come back to me, and then I'm going to consider to do it. And they buy time to build conviction, to get to know you, to meet you, to show them that you can feed them with updates and progress. So the market has a tectonic shift in how the market LP GP relationship is behaving.
Yeah, totally. When I reflect on the time, I thought 2020 with the lockdowns, I thought everything is over now. B2B pharma was anything but digital. And I thought, no way. I mean, if people can't meet, how should they drive their business forward then? I mean, lockdowns are the death for the industry. But they adopted very quickly. So it totally makes sense what you said. Digitalization, SMEs, enterprise corporates, they moved on and the market was thriving. Governments were throwing money on the market. It eventually ended up, I think, at potential LPs, institutions. They had to invest in public markets and private markets, and venture funds were a logical conclusion at the end of the day. And I think,
just to add one small thing, there is one macro which is determining how much money is raised in venture capital, which is at all times interest. So interest was
really?
not, well, of course. Well, just think about it. Like, think about the nature of venture capital funds, how they perform. Right? So 2% of all funds make 80 or 90% of profits. So you have to be a very good picker, even as an LP, to find these 2% to have great companies. Looking at the past 25 years, averaging out, the TVPI of all funds is 1.3, 1.4. So it's actually not too stellar. If you kind of translate this into IRR, it's below private market equivalent. If you take the past 25 years, more money has been invested into VC fund than returned to LPs. So A, it's not liquid. B, it's high risk. C, you have to be a good picker. So if I have a zero interest environment with a high inflation, well, take my money. That's why the money was flooded with, the market was flooded with money. All of a sudden, we saw like, oh, yeah, interest is going a little, not interest, but inflation is going too high. So obviously, interest has to go up. Interest went too high. And all of a sudden, bonds and fixed income become interesting again. You can put your money somewhere and yield 4%, or you can put your money into the average Joe fund and yield 6 or 7%. The delta, the spread between the actual interest rate and what an average fund will yield doesn't justify illiquidity and the risk. So in order to justify it, you have to have a spread of 10-15% to justify the risk. That's how the market works. So lots of companies or lots of people who invested into venture were overexposed. 21, 22, everybody had this gold rush mentality and just threw money around. And then they had no money. And then all of a sudden they said, well, no money's coming back because M&A market is dead, public market is dead, everything is dead, nobody's selling companies or buying companies, so I don't have money to reinvest. What I'm going to do is the money I have, I'm going to reallocate into like secure harbors. fixed income, bonds, real estate, brick and mortar, and my existing portfolio. That's when the market dried up.
Mm.
And this year, what we're seeing is either it's a mental thing, this is the new reality, so let's go back to business, or the fundamentals are getting better. I think it's a mix out of both. A, inflation has never been as low as it is right now for the past 3 years. B, interests are gradually going down. So the party on the fixed income and bond part is over. Real estate is not an option. People don't invest into real estate, but they collect nice rents. So liquidity is going up. And therefore, activity on LP side is going up again. And this is how I try to understand the current world and our world. So the momentum is definitely picking up this day. But there's a small but. All the established funds which didn't go out last year will hit the market this year. So it's going to be crowded again, even though if there's more money, even though the momentum is there, there's going to be more people asking for it. So it will kind of equal out.
There was one interesting point in what, I mean, there were many interesting points in what you said, but I want to pick just one. For my next question, you said, I hope I understood it right, that of all funds created in the last 20 years, only 2% created outstanding returns.
No, only 2% created the majority of all VC profits.
The majority of all VC profits.
But here again, you have to think about the nature of venture capital. Take the biggest 10% funds and how much they deploy, even if they return just a small TVPI, the absolute returns are very high compared to all the micro funds, 10 million, 30 million, 50 million. Even if you quadruple them, a fund which is badly returned or like have like bad TVPIs or DPIs, managing 1 billion is still returning a multiple of an outstanding outperforming micro fund. So you have to
But I think in my world, when I talk about outstanding returns, I talk about anything north of 20% per year average. So when I see, for example, I mean, interest rate now is about 5%, 4.5, 4%. I think there was not a decrease. Is one hurdle rate. The next hurdle rate, S&P 500, it's about 8 to 10%, almost automatically. And I think any LP has always the opportunity or the potential and the means and the methods to buy some ETFs in the S&P 500 space. Yep. Then you have these vehicles like Berkshire Hathaway with 20%. So when I think about outstanding returns, I think about 20%, 30%, 40%. Yeah. How many funds are out there on the market in the venture world who can deliver some?
I have to ask you a counter question: realized or non-realized?
That's a good question.
So I know many funds which sit on golden gooses, sitting on 6, 7, 8x TVPI. The question here again is, you have one weird flaw in venture capital. The IRR is always against you. So every year you wait, well, it's going to decrease your IRR. So many funds which actually are in the divestment period or at the end of the term of the fund in year 10 or 11, they are actually right now actually supposed to divest. You can't divest. Nobody's going to buy it. And now it becomes very weird. You have these great assets, and they are maybe 80, 90%, 2 or 3 assets are 80, 90% of your TVPI. And the value of these assets, I mean, take simple example, take WeFox with 4.5 billion. Who are you going to sell this to? How are you actually generating liquidity? Unless you're a small fund and do a secondary. How and when? I don't know. So the paper value is nice. Unrealized IRR is nice, but realized IRR, there's not too many funds which kind of created 20% realized IRR. But here again, if you compare the US to Europe, well, when did venture capital in the US start? In the 60s, last century. When did capital pick up or became a real thing here in Europe? 2000? So our industry is 20 years old. Our professional industry is 10 years old. The term of fund is 10 years. So we have the first vintage, which is done from professional cycle of a fund. It's very hard to compare it to the US. It's very hard to kind of benchmark it to the US. So what we're going to see in the course of the next year is that the reality will hit in, and you will see if the paper values actually materialize in DPIs. And many of them will not. And selling is an art as well. So if you think about it, it's like, hey, this is really cool. You build a company, you invest it very early, you sit on this multiple fund returner, valuation is 2 billion. You're going to take it IPO, you list the company in the US, right? Then you have a lockup period. You don't get a green shoe. You can't sell. What is happening after the lockup period? The market will judge this company based on actuals, like where's the market going? Where's the company going? Is the company profitable? That's how public market works. And they realize take all the tech IPOs. Well, there's some outliers obviously which worked well. Then you're going to realize the valuation of 2 billion is not the fair market value. So you end up not selling for a valuation of 2 billion, and TVPI in your fund is not 2 billion, but it's rather 800 million. And the reality will show then that it doesn't work. So that's why I'm always trying to understand, is Europe ready for 300 million plus funds? Or is Europe a fantastic market for micro funds which are sub 50 million, where you have to sell companies for 300, 400, 500 million to actually get your fund back? If you don't have them in a portfolio, you can't create this 20% IRR fund. It's not possible. Mathematically, it's not possible. So I think the market still has to mature in order to show that VC is a real asset class in Europe. It is, for sure, out of question. The question is rather for which fund size.
What's your opinion?
I think funds up to 100 million can work fantastically well in Europe. It has the maturity, it has the exit market, it has the liquidity. These mega funds or funds which you have like in the US with 1 billion in assets under management, they're very hard to return. But you have to understand the underlying economics of who's investing into these funds. Pension funds, endowments, institutional investors, they don't have the expectation of a 20% IRR yield. They have the expectation, please return to me anything between the public market equivalent and bonds. If you constantly give me these returns, I'm going to be constantly giving you money because they have the money somewhere. They can't all put it on the public market, so they put it in real estate, public market, bonds, venture capital, private equity, buyout, name it. And one big allocation will always be venture capital, but into established funds. So what's interesting as well about venture capital is you build a first fund, you double it, you triple it, you quadruple it, and what's happening, it's always better for you. Why? Because you're de-risking. You're moving an unliquid variable, carried interest, into a liquid fixed component, which is management fee. So if I have a 10 million fund, I get 250,000 in management fees per year, right? If I have a 100 million fund, I get 2.5 million. I don't necessarily need a team which is 10 times bigger. So I just increase my paycheck. So every month I'm collecting my money, which is very nice. Now go to the carry component. Yes, it's easier to return a 10 million fund. It's harder to return a 100 million fund. The LPs in the 100 million fund don't expect 20% or an outlier. The one in the 10 million fund, they do. Because for them, this moves the needle. So the guy in the 100 million fund said, why would I take the risk? I'm going to return 200 million and I'm going to take my 20% out of the 200 million, which is a 20 million paycheck. I just made 2 million a year in carried interest if it would be solo GP. The guy sitting, hustling every day in a 10 million fund, returning 5 times the fund, gets 20% of 50 million, 40 million to be accurate. So it's 8 million. So even though your performance has been 700% better, what you're getting as a GP is just a fraction of what the guy gets in a 100 million fund, not doing a good job. The question is, what's the expectation of the LPs? The farther you go up the ladder, the expectations on the IRR yield changes. Just give me constant returns, not outsized. I just want to flatten the risk. That's why people go up market. You raise bigger funds and de-risk yourself. More management fee, more carry, less performance. That's the most awkward thing about venture capital.
Yeah, know your customers.
It comes by nature. So
I think from what you said, for me, the lesson is know your customer. Know your customer, basically. Also, a fund has a customer, it's the LP. And what my thought was while you were speaking, that probably smaller funds cater to customers who are in the process of building wealth, who are still in the building phase and need outsized returns, while the customers for bigger funds in 100 millions, billion, for example, probably have different challenges. They need to just secure what they already have built in the past. So as long as they get the inflation rate returned, it's fine. It's a means of diversification. So it's basically they have
One is
enough.
wealth building, the other one is preservation.
Yeah.
I'm saying institutionals think differently than the high net individual or small family office. They still build wealth.
But why? I mean, venture funds always invest in high risk endeavors.
Yeah.
Basically, why building huge venture funds then? Does it make sense? I mean, can you allocate huge funds in venture businesses?
It does make sense because you have to think about the whole value chain of venture capital and startups. So there's early stage, there's mid stage, there's later stage, there's growth, there's IPO, right? So for each part of the stage, you need a different bucket. So the risk profile changes and the way you invest is changing. So what you do as an early stage funds investing pre-seed and seed, you optimize for two things, alpha and beta. You want to have more loss ratio, but you want to have higher magnitude of alpha. So if you hit, you have to hit very, very hard and return your fund. Go down the road, think about the growth fund. They opt for only one thing, alpha. There is no beta. You don't write off. What you have is a good performing and a bad performing asset, but you don't have write-offs. Think about a secondary fund. Same thing. Short period, only alpha. So everything you do has to survive and return at least your money. Some will return more money than you invested. This is the profit. Due to the short cycle, you have a very high IRR. So thinking about venture capital, you have to cluster the stages in order to understand why LPs invest into them. And then you have to go behind the funds and think about why LPs invest into these funds. If you have a pension fund and you manage $500 billion and the allocation for the VC bucket is on an annual basis, I don't know, 50 billion, what are you going to do? Put 50 billion in small funds, 1 million in each fund? You're going to be very busy finding these funds. You have completely indexed the market then. You've put in every emerging fund 1 million. A, you can't manage. B, it's too much work. C, the overhead will eat your returns, even though you would have a blended return, which might be higher. So what you're going to do is you slice the 5 billion into 50 checks. Full stop. And you put 100 billion into every fund, which you think this makes sense. And exactly what you said. You counterfight dilution, inflation, and you might make little more than the private market equivalent. Blended on the overall portfolio of 500 billion, it's not going to move the needle in any direction. But the money has to go somewhere.
Yeah, it's like Sebastian Mallaby wrote in the Power Law. I mean, it's not it's fund funds, it's SoftBank, but he titled the chapter about SoftBank in Everybody Needs 100 million. So.
Yeah. And it's absolutely accurate.
Yeah, it's a challenging game at the end of the day. It's a challenging game. I mean, it also means for founders, founders, they need to understand for different stages of their corporate development, what the customers of the VCs are at the end of the day and what their expectations are to deliver the right cases to the right VC at the right time.
Absolutely. I couldn't agree more.
Okay. This is a lot of work, to dig into this market.
Here again, you have to always reflect that the maturity of the market. The venture capital market is in kindergarten here in Europe.
Yeah.
But the guys in the US, they already do their first college degree.
We are still early. So it's Jeff Bezos would say it's still day one. So
yeah, like your favorite thing I heard the other day is like the mentality delta between US and Europe is very simple. US startups think in $0 billion companies, and European companies think in $0 million companies. And you have to have this again before you get it, but at least it was for me. It's like, yeah, exactly. Just think bigger.
Yeah, that's true. That's true. And I think also one thing that stands out in my opinion on the US market is, I mean, correct me if I'm wrong or if you have a different opinion, please. I think Europe is very tech driven in their approach. So whenever I talked to my small ecosystem, I have the feeling that it's all about tech and does this technology succeed or that technology succeed? And then funds invest in technology and IP and then have a team to move it forward. Whenever I talk to the US guys, I have the feeling it's all about the team. So that they look for establishing teams on the market that can run a company for over 10 years and then build a huge success story on the market. And it doesn't matter so much what tech they feed into this team. How do you see the differences and similarities between the investment approach in the US and in Europe?
The most important thing is risk appetite and risk profile. There's a very different risk profile in the US. And I like to say that because I think it's very true. In Europe, we just have the mentality of what could go wrong. The US
Really?
mentality, yeah, absolutely. You look, you're a VC, speak to 100 VCs, how they assess companies. 90% of the conversation will be circulating around, I don't know if the GTM is going to work. I'm not sure if this is the right CTO. I'm not sure if they actually find product market fit. I'm not sure if they can scale their sales, the tech, whatsoever.
We are members of this ecosystem, so we are the same, basically.
Yeah, and then US, you rather think about what can go right. So can this be an outlier? What about if they crack this nut and become the market leader in this? What's the potential if this happens? So the mentality looking at an early stage company from a different part of the table changes the whole view on things. The second component is liquidity. There's more money in the market. Think about how much money in the venture capital market in the US is and how much money there is in Europe. Accessibility is easier, B, it's more. So even companies which might not seem like the best or smartest in the world receive more money. So you have just a higher hit rate because more companies get funded. And I think Europe still has to learn quite a lot. And it's going to take quite some time. And here again, we're in kindergarten, they're in college. So it's totally fine, but we're picking up fast. That's very important to learn and to understand. And the mentality shift will come with next generations with experience and as well experienced managers, not only entrepreneurs. The ecosystem lives on both sides of the table, right? And we will eventually get there. This is the bottom line. But it's still going to take some time to actually catch up with them or be on eyesight. And what people build in the US is global footprints. What people build in Europe is European footprints. So we build companies for the European market. Name me one company which is a global player in B2C. There's none.
Before I start crying, let's change the topic.
Yeah, well, we're not there yet. That's what I'm saying.
Why we're in the same age group, basically. So we are kids of the 70s, 80s, and 90s, basically. When I think back to the 90s, in the world I lived in, I mean, the internet was still young, but I had the perception that Europe is taking off. Europe was leading the mobile revolution, basically, in my opinion. We outplayed the United States.
Yeah.
The public markets in Europe, I remember, were thriving in the 90s. And the US, most of the time, Dow Jones seemed to be flatline until the end of the 90s, where the bubble took off. And I had the feeling that Europe at least is on an equal level like the US. China was lagging far behind. I mean, 1989 was a few years ago. The Chinese market was seemed to be like in the Middle Ages, exaggerated compared to Europe and US markets. And this was the emotion that I had when I started into the 2000s. And then we had, the bubble burst. And then we had this 2008 crisis and problem. And somehow in the last 10 years, I realized Europe has lost it. So, I mean, basically Europe is playing, you said the market is still young. When we put it in this European negative perspective, everything went wrong that could go wrong here in Europe. China outplayed us. Sebastian Mallaby described it very nicely in his book, The Power Law. The US market was thriving. And when I asked Sebastian Mallaby on my podcast why he didn't mention Europe in his book, he said, because there is no venture market in Europe. What's your opinion? Why did we miss that? What were the reasons that we missed it, and what should we improve in future so that we can close the gap to the US and to the Southeast Asian markets?
Yeah. I would nail it down or narrow it down to one thing. It's risk aversion. So the risk mentality we simply don't have. Here again, like when you think about venture capital, there's this one very awkward thing, and it's so counterintuitive when you think about it. But if you give it a second thought, you're like, yeah, actually, you're right. So if you look at deals and everybody looks at a deal like in an IC and everybody says, this is the greatest deal in the world, you should not do the deal. Very simple. Why? Because the deal in an early stage company, especially, doesn't have the risk profile it has to have. It has to be contrary. Somebody has said, it's the stupidest thing I have ever heard in my life. It's the stupidest thing. Don't do it. So when you think about venture capital funds and how they operate and how they become successful, funds with outside returns, any fund above 5x TVPI return, have one thing in common. They have a very high loss rate. Loss rates range between 40 and 50%. Funds, which are mediocre or still good but not bad, have a loss ratio of rather 30%. What does it mean? It means you have smaller returns on the companies which you hit, and that leads to smaller outcomes for the whole fund. But you try to opt for less beta. But in venture capital, the power law is the most apparent thing. Like one big hit will change the whole outcome. So the top funds, what they have in common is not only the loss ratio, but the magnitude of outliers. So the magnitude of the outliers which they have in their portfolio is twice as high as the magnitude of outliers which not well-performing fund, anything between 2 and 3x, which is already good fund to be fair, have. So you have to kind of wake up and say, no, I have to take the risk in order to create outsized returns. And the US have mastered that. They look at deals, they see a deal, it's pre-seed, there's 3 smart guys, they tackle a market, try to kind of revamp the whole market and do something differently. They receive a 20 million check. We had these weird times like here in Europe where Gorillas all of a sudden got funded, was the fastest unicorn, or Tier, or like all these companies where we kind of said, oh yeah, we have to, you have to take everybody kind of jumped on this train and said, this is going to be the next thing. Turned out not to be. But what we like to do in Europe, it didn't work, so we're not going to do it again. What the people do in the US to say it didn't work, so we're going to do it again. Till it works. But in Europe, people are scared away and say, wow, I'm so biased. I did this already. It didn't work. I'm not going to do it again. But then you miss on the opportunities which will work eventually. And the mindset towards taking risk and accepting that risk is the biggest part, or the most important part to assess in venture capital, it's not there yet.
How can we change that?
Here again, I think you can fast track it. It's experience. It will simply take a little more time and a certain degree of professionalization of GPs. So even if first professional GP started, let's say in 2010, the first big wave of operators, whether it's a Sherry type of fund or if it's Project A or like the first one which actually built brands over time, these companies are in 4th or 5th fund generation. Right? And the first one has not even be fully divested. So they know the cycle of investing, they know the cycle of managing these companies, but they're still in cycle of proving, hey, I can divest this fund. In the US, well, they have like this head start. They're 50 years ahead. They've done this, they've seen this, they've passed this knowledge, and they embraced the risk associated to venture capital. We just don't have this here. So I think we need a little more time. You can't fast track experience in venture capital, full stop.
It doesn't matter in which investment area. I think this is, as you said, experience driven. It takes 10 to 20 years to go through each single learning step.
Absolutely.
And not giving up. You mentioned the contrarian approach, contrarian mindset. That you said, you didn't say it contrarian, but you mentioned, I interpreted it. You said that when everybody says it's a smart thing to invest somewhere, you shouldn't do it. And on the other hand, it means when everybody says it's a stupid idea to invest now, maybe there is something in this area that you should look at. And when I look back on all the big funds that created outstanding returns, they had some sort of contrarian approach to the market. Genentech, for example, I mean, I'm mostly in biotech, and Genentech was one of these success stories that, in my opinion, created the venture industry in biotech, where a fund manager invested in an idea where everybody said, it doesn't make sense, doesn't make sense to move in that. direction. When I look at the European market, from what you said, is we don't have this mindset. What I'm curious to learn from you is how do you convince your European LPs then to go into venture capital? I mean, you have another hurdle to take. Not only do you have to explain the venture world and the venture model, but you also have to help them overcome their fear. How do you do that?
Well, I think there's many experienced LPs. I mean, they don't only invest here in Europe, they invest across the world. And the maturity of LPs is, I would say, almost equal to the ones in the US. And they have risk appetite. The only thing which differs quite a lot is the actual fraction of the allocation into venture capital. So if you have a portfolio of 100%, here in Europe, it might be only 3 or 5% what actually goes into VC. In the US, it's way more. So it's more people and it's way more. So the absolute outcome is way higher. Here in Europe, they like venture capital. They do understand they have to have an allocation. They kind of tiptoe into the water, but the actual exposure in this asset class, even though in average it's the highest yielding asset class in the past 10 years over their whole portfolio, they have the smallest fraction in that. There's very interesting surveys about that, like how's the portfolio or like the overall asset allocation of family office and so on. Smallest fraction is always VC, highest IRR yield is always VC. So you always have to think like, hey, you make the most money there throughout your approach, either direct or funds, but you don't increase it. Here again, risk averseness. So you like income, you like liquidity, you like bricks and mortar, so you kind of don't shift between your asset classes.
But why? Why? I mean, you just, if I understood you right, we have LPs in Europe that have the experience. Yeah. That have exposure to global markets, understand the venture model, understand the risks, the upsides and downsides, have already experience from the past 10, 20, 30 years with their investments, see on their balance sheet that the venture class created the biggest returns for their balance sheet in their investment portfolio, and then they don't increase it.
I would love to.
Does it make sense?
No, it doesn't make sense. But I think it's a two-sided question. One is like, even though the yield looks great, it's not materialized eventually. So it looks great on paper, but didn't return yet. That's the one thing. And as long as they don't get the understanding that the money will flow back at some point, they're not increasing their overall allocation in venture capital compared to the whole portfolio. So they keep it at the same level. There's two ways on how the absolute amount increases. A, the portfolio or the wealth becomes bigger, so they stay at 3%, but absolute amount is going in, which is higher. Or they just increase and stay wealth is the same, but I just increased that part of my allocation, which means you have to divest another one. Bricks and mortar, usually you don't. Fixed income, anything which is more liquid, you do. So I think there's as well a structural delta between how the US works and how Europe works. The money which is here is family-owned wealth, like accumulated over many generations. This wealth is treated differently when somebody inherits money, right? And in US, the structure is simply different. And I think this leads to this over-allocation in venture capital. And of course, venture capital, I would say per se, is more successful because you have a liquid market at the end. You have an IPO market, you have the NASDAQ, you don't have these kind of things here in Europe yet. They will come, but they're not there yet.
But I think when you look at the history, BioNTech, Spotify, the few success stories we have, it's no problem to IPO a company on the US market, even with a European footprint. So it's
not. But if you IPO, well, you took outliers here. But if you IPO on a like small cap non-liquid market, cool. Then you have a listed company in a non-liquid part of the market because it's a small cap.
That's true. That's true.
Oh yes, you did an IPO, and yes, you're NASDAQ listed, but the volume is small.
But when I look at the founder side, from what you say, I see a structural risk in Europe that we just lose our economic power entirely if we don't change that, if we don't allocate more capital. It means for the founders, when I compare US founders with European founders, you mentioned this 20 million check. You have a great idea, you have something that makes sense, and you find a fund who invests in your company 20 million right away. It doesn't matter if you succeed or not. And if you don't succeed, they still stay in touch with you and they come back when you have the next idea. Maybe we do something with you. And in Europe, they're burned, basically. Very often, I think, in my opinion, at one point in time as a company, you need money to play. It doesn't make sense. And when you look at the situation of European founders, very often they end up discussing with managed funds and then have to prove the next thing and the next thing and the thing after the next thing. How can we get the market? How can we get the market more liquid in Europe? Do you have, from your experience, do you have any one trick that will fix it all in next year?
I would love to have the smartest answer in the world. I don't have it. I don't know.
Okay.
I would claim it's the maturity. But to be fair, the public market in Europe, even if you look at the DAX 40, think about, and had this very interesting conversation with a PE fund the other day. It's like, how many of these guys will be there in 20 years? And I think 20 or 50% of the 40 will not be there. So here again, the structure of our public market is a very different one as well. And the volumes we have on the public market here in Europe are very small compared to what's happening elsewhere in Asia, in the US. So I think it's a very political thing as well. It's not only structure and liquidity, it's like how politics manage that. Regulations, another one.
What would the one regulation be that you recommend to change to improve the situation for Europe just a little bit?
I think like the best journey start obviously at the beginning. Most people are scared from building companies, and most people who could potentially invest into startups because they have the liquidity don't do it, because there's no tax cuts, there's no grants, there's like the politics keep on cutting them down. They used to be on a very positive level. ESOP is another very big discussion here. And now it seems like we're going backwards again. And so the incentives for people investing into this very high risk, high yielding asset class are going down. And actually, if you think about the nature of how Germany works, and if you think about who's the biggest employer in Europe or in Germany, startups. If you would take it as an industry, it is. Why do you put such a small fraction of what you have in financial capabilities into that part? We got better. We have the EIF, we have KfW, we have more institutional money, but we have to think about the whole cycle of the funding curve. It's not only like, putting money into funds. You have to kind of enable angels. And many other countries actually do have this, have tax cuts, have incentives, have refunds and so on. And I think here again, we're not there yet in Europe. Make it more appealing as an asset class will lead to more money going into this asset class, will lead to more innovation, will lead to more companies which are global players. And one interesting thing is like we create great stuff. We are fairly advanced when it comes to technology. And I think we can even outcompete many of them in the US with the technology and knowledge we have in Europe. What we can't do is, if there's something fantastic here, some smart guy or girl in the US thinks, all right, I'm going to do this. I'm just going to do it faster. Why? Because the money's there and the risk appetite. It's like, look, there's a company in Europe, they're doing this. Let's do this here, but just let's do it faster. And before these guys in Europe think about going to the US, to Asia, wherever, global, the market's already taken.
So we need to talk to our politicians at the end of the day to change the environment and make it more entrepreneur and investor friendly.
As part of the equation, yes.
It's part of the equation, yeah. Yeah, I mean, currently, when I look at Europe, currently we're living off the wealth that our grandparents and parents built with the companies of the 70s, 80s, and 90s. Yep. And all the big stories that we see today on the stock market, on public markets, Apple, Google, Tesla, they're all venture cases, basically. And Europe doesn't have any of those companies. It doesn't have created any of those companies. I mean, also when you look at solar, at electric vehicles, it's empty.
Yep. And that's a problem.
Then we have to address the politicians more often.
I guess, yes.
Yeah. When we talk about investing to motivate our pension funds that we have also in Europe, you mentioned the contrarian approach. Let's talk a little bit about this mindset. How important is it for a venture fund?
To have this, to have the contrarian approach.
How important is it for venture funds to not follow the crowd?
Very important. I mean, if you follow the crowd, you're like always in a very dense place, so you're exposed to competition. That's one thing. And trying to do like what we always try to do and to think about is like how can we be ahead of the wave? So that's why when I earlier said like when the tourists arrive, you should leave.
Mm.
And when you enter a market, when the tourists are there, well, you're too late to the market. So the big art in venture capital is being ahead of the curve and understanding in what cycle the curve is. And I think the Garden innovation cycle is a very good example. There's fantastic markets which pick up aggressively, then they drop, then they mature, and then they become real markets. Web3, yeah, AI. There's many of them, biotech even, right? So everyone is excited. Everybody thinks they're missing on something. Then they jump on it, and then the excitement is gone because this market has eventually to mature, and then it becomes a real market. And I think it's very important to try to identify how the next 10 years will look like in industries. And that's where the advantage of many small and micro funds are. They kind of focus on a specific subset of a market. They understand the market. They do the extrapolation, think, okay, these are the micro trends in this market, which will determine how the future will look like in this industry in the next 10 years. And they bet on them. And we see, well, if I invest, I want to make sure that this company is in a market which is A, there, B, relevant, and C, sizable in 10 years. So I have to have this mindset how the world looks like in 10 years. And it's very hard to kind of adopt to this approach because most of VCs don't have the imagination how this, I mean, in many cases, I don't have it either. So we have to speak to experts, we have to speak to industry insiders and so on. So they invest with everyone else. So if you see the volumes are going up in this industry, people put the money there because they think, oh, this is the next bet because everybody's doing this bet. But what people neglect is to look left and right what's happening next to these industries or which industries could be affected because this wave is going on. And we try to incorporate this mindset of like, how will the world look like, especially in B2B, in our particular case, in the next 10 years. And we think the main driver will be SMEs, will not be enterprises anymore.
Mm-hmm.
And it, of course, there's associated risk to that in any case, but there's as well big associated risk to bet on what everybody else is betting on. And here again, come back to statistics. Well, great funds have higher loss rates, so they're more often wrong than the smaller fund, like funds which don't work that well. That means if you try to follow people who bet on something, they might be very much wrong. So you're betting on someone who doesn't even know it better than you. They just have more money to do these bets. And you can see it, even if AI is surely one of the hottest topics, not everything in AI is as fundable as it used to be 1 year ago.
Mm-hmm.
Because the market is changing so fast. Like generative AI must be like, would I touch it now? Probably not. And this is a very bold statement, but I know that there's another thing in venture capital, the circle of competence. You have to accept what you know, but you have to accept what you don't know. And both fields are good. Knowing what you know and understanding and investing into them, and investing into stuff you don't understand. But then you're like literally in God's hand because it's a blind bet.
But if you want to play contrarian, the chances are very high that you need to go into areas that are relatively uncharted yet.
Absolutely. I agree. It doesn't mean that you don't understand them. It just implies they're uncharted. You can be the most fantastic person in AI, and you're like, well, this is an untapped part of the AI segment, but I think it's going to take off in the next 5 years. What you want to invest into is before the curve starts, not when it's on the peak.
That's true. I think to me, the best example is Bitcoin. I mean, everybody could have become rich with Bitcoin, billionaire. I think in 2010, the price for 10,000 Bitcoin was $41. Now it's at 72,000, and you see these cycles, these hype cycles. And when the hype hits mainstream media, people try to buy and try to invest.
As we speak, you can see it literally as we speak.
And the VC world is not different to that.
I would definitely say it behaves in patterns and cycles, and it swings with the economy. So here again, inflation, interest rate, fundraising, market dry ups, market is down, market is going up again. And there's a natural component to VC. The best companies being created in venture capital are created in down markets where money is scarce. Because the mindset of an entrepreneur is a very different one. If money is a commodity and vastly accessible, what are you going to do? You build a company, you burn as much you can, you raise more. Because you can in an up market.
When I interpret what you said, for me, the magic of a VC, of a venture manager, of a fund manager is basically a sales skill. When the opportunity is in the down market and you need to be contrarian, but know that you have to deal very often with risk-averse people, you need to be good in selling to convince them to do something against their nature.
It's funny. It's like I always say, like fundraising is always hard, an up market and a down market. The only thing which changes is the narrative. In an up market, everyone is excited, so the narrative is circulating, and you're missing on this great thing which is currently happening, right? On the counter side, is lots of people are out. Everybody's going after a lot of money. In a down market, not many people are out, but there's not much money. But you're selling the exact opposite. Look, now is the time to buy. You want to buy into the market when the market is down, exactly like in a liquid market. You don't want to buy the peak. You don't want to buy Bitcoin on $100,000. You want to buy it when it's down. It's going to go up again. VC do the same thing. Look, we're in a down market. Entrepreneurs are humble. VCs are humble. Everyone's going back to fundamentals. We're going back to default alive mentality. People are looking on one KPI, capital efficiency. What can you squeeze out when I give you $1 million? In an up market, I give you $1 million, and then you kind of think you're a rocket star when you create 100,000 in revenues. In a down market, somebody gives you $1 million and you create 2 million in revenues out of that. So capital efficiency changes because the market's not liquid. That's why best companies are created in down markets. The shift in mentality from VCs giving companies to smart founders who deploy in a smart way.
It's all about selling at the end of the day and delivering returns then at the end of the day.
Yeah.
With the right story. How did you learn your sales skills? What is your recommendation if somebody says, okay, I need to, I mean, for me, entrepreneurs and investors both need to be proficient in selling, otherwise they won't succeed.
Absolutely.
What advice would you give them?
I think there's two things. Selling is just one fraction of the overall picture. It's brand. So brand building is equally, but what does people impress? Halo. So people look at who you're hanging out with. People look at how exposed you are, whether it's on LinkedIn or YouTube or wherever, like whatever the medium or Twitter. So people are impressed by very simple things, I would say, right? So brand building and having a brand by yourself is very valuable. And then translating this into reading other people. Like there's different people, and you have to kind of try to understand very early in the process when you meet people what the motivation is and what they want. Some LPs want financial returns, others want strategic returns, not strategic returns, but strategic aspects which are relevant for them. And you have to piggyback on what you think the other person on the other side of the table actually is looking for. So you tailor your pitch towards that. Doesn't mean you should be lying, doesn't mean you should be unfaithful, not at all. Just means that you should A, listen, and B, try to understand and read the other person on the other side to kind of refine your pitch towards what they actually want to hear without, lying or being unrealistic. And I think this is the main art. How did I learn it? I don't even know if I mastered it. But if you speak to people every day, I don't know, if you have 6 calls on average, I would have at least 6 calls with people. Get pretty good at that. Reading people, understanding people, look what they're eyeing on, knowing how much to speak or when to be silent. And I think that's the art, reading other people.
Yeah, when I look at Germany and Austria, it's tinkering with technology, and the teams need at least one on board who enjoys being amongst people, being out on the market and talking to potential customers constantly.
Yeah, absolutely. I think it's the same. It's the same thing in startups and in funds. You have to have this one very exposed person who likes to be in the spotlight, who likes to read, who to speak. And if you don't have this, you're not going to succeed. And sales makes the whole machinery go round. If you don't have this, not going to work. Not as a VC and not as a startup.
Important advice. At least get one on board of a team. It doesn't matter if it's a fund or a startup who loves talking to people.
Or get enough money so you can pay someone.
That's the second route.
Yeah.
VCs need to be good at predictions. When I look at Europe today, and with all the challenges we face currently, wars, interest rate, the aftermath of the lockdowns with supply chain disruptions, I think I sometimes hear that they are still there in some sectors. Where do you see the venture landscape in 5 years? Just guesswork.
Yeah. Unfortunately, I see it exactly where it's been 2 years ago. What we like in venture capital is we like to be shocked when things change, and we like to forget that we have been shocked. So you might look back and you say 21, 20, why were people so outrageous about investing into these crazy companies which all didn't work? Well, how could we have been so stupid? That was so evident it's going to happen. And then 5 years ago, look at this company. Let's give them 50 million in a seed round. This is great. It's going to be working out all perfectly fine. So people forget. That's a problem. So I do assume we will see in 5 years down the road a very similar market as we've seen in the past years. That from everyone being very humble, very modest, going back to fundamentals, eyeing at the right KPIs, we're gonna move more into, all right, let's forget all about this because the markets become more competitive. And that's here again, it's unfortunately the nature of the market. More money in the market means more competition, means time between rounds is decreasing, means rounds are getting bigger, means valuations are getting higher because people outcompete each other with higher term sheets or term sheets with a higher valuation. And that's the beauty about a down market. Less money, less pressure, more time, more conviction building, better deals. And as the money is flowing in again, it will stack until we have this weird situation that you have, I don't know, X billion dollars in dry powders only in Europe, which has to go somewhere. It will attract stupid people building stupid companies, receiving money, just stupid money as well. And the great people will be hunted down by the great funds with outsized valuations and rounds, which leads to the next problem. Well, you have to create a $30 billion company to actually make this company somehow relevant in terms of returns. And it has been like that. It will be like that. And if I would say whether we learned out of the last, I would call it friendly correction or step back. Maybe yes, but I doubt it.
Let's keep playing the game. This is how we grow at the end of the day.
Indeed. But I mean, it happens in the US as well. It's not a European phenomenon, right? So, and here again, people live off this FOMO. They are afraid that they miss this next big deal, so they take stupid decisions.
When I look on the tech markets in the last 40 years, Europe, US, and now we have emerging markets. I mean, Southeast Asia is very big. Meanwhile, I learned also that the Middle East has a thriving venture scene. Saudi Arabia, Dubai, they attract a lot of capital, and it's all over the internet currently that so many people travel to these regions.
Yep.
How would you position Europe in this global game? What are our strengths?
Very simple. We have the intellectual and technology advantage. So in certain sectors, AI, machine learning, quantum, cyber, biotech, longevity, we have certain edges. We're very well-educated spin-offs coming out of great universities. So the intellectual property we have in Europe is our biggest strength. Our biggest weakness is we don't have the matching capital to do it. Going to Middle East, they have a lot of money, they have a lot of capital. It's endless somehow, but they don't have the talent and they don't have the ecosystem to build great companies. So eventually, money will always flow where the talent is. So that's what we've seen as well. Lots of money is coming from Middle East to Europe. Lots of money is coming from the US to Europe because that's where the talent is. When you look at US, they have somehow both. They have strong talent and they have the money. That's why this market is like kind of a perfect match. When you think about Latin America, more and more education is coming in. People from Latin America go to the US. It's the backyard, get the education, build great companies, what they've seen in the US, and replicate them. Money from the US is flowing in. So that's why this market has been striving over the years. If you look at Southeast Asia, they don't have, it's still very emergent, similar like Latin America, but they don't have the US as a backyard. They have China as a backyard. China is the market. So accessibility for capital is becoming lower throughout politics. So this market will still eventually thrive, but I think it will do so slower due to the lack of actual talent and due to the lack of money, which is actually nearby. Either it's in Singapore, it's international, or Hong Kong, or then it is in China, which is still kind of locked up. So the perfect storm definitely is in the US because they have both and both is accessible right there. Europe has just to pick up their pace when it comes to actual liquidity in the market for these kind of cases, because we have the talent, we have the market, and we have the chance to build companies with a global footprint. We just don't have the risk profile.
It's a great opportunity for funds at the end of the day then, and for LPs.
What a time to be alive to build a fund these days. Investing in a down market with this kind of intellectual property we're having over here, what's scarce is money. So everyone who masters to raise a fund these days and deploy it in the course of the next 10 years will likely have above average returns.
I definitely believe that. Believe that. As long as we don't shoot in our own knees and we keep the markets growing and set the regulations right, I'm pretty sure that Europe can succeed.
We have a certain degree of political insecurities, but let's see about that.
When it's really amazing talking to you. You know so much about the venture market. I'm really impressed, and I love learning from you. We have 8 minutes left. Yes. I know that you have some other obligations as well. In this game of investing, when potential LPs and startups listen to your episode, let's talk about how you position your fund in the market for the next 10 years. What kind of startups are you looking for, and what's the promise that you can make to LPs?
Yeah. So first of all, we thought about, like, when we started thinking about Altitude, what kind of fund are we going to build? Is this a one-hit wonder? Is this something we're going to do for the rest of our lives? We hope so. And how are future funds going to look like? And we looked at many funds and how they succeeded and became what they are, how they built a brand, a community, and an ecosystem for themselves. And just a small set of these funds have managed to do it successfully over multiple vintages. A good example is Point 9. Stay in your ballpark. You always do what you have done. Focus on SaaS and marketplaces with the same size of fund. So one thing was pretty clear for us. We want to stay in the same ballpark where we are. We want to master this domain. We want to gain the domain expertise and want to become the go-to fund for SME tech in Europe. Europe, I think here again, we're in the kindergarten stage of where the market is going to develop. So our value proposition towards LPs is, by building a brand, by building the community, and by building the domain expertise and knowledge, we will be eventually the go-to fund for early stage startups to actually receive funding for. Because even though you're a very smart founder and you have a great idea, you will be lacking eventual part of what you need to become successful. And in early stage, especially in SME, when this is your clientele, it's mostly about go-to-market. It's your CAC and LTV ratios. It's churn rate, it's average contract values, and actually how to master this in combination. So what we are specializing on is not giving money. There's a lot of money in the market. Why are we getting into rounds? Even though there's no VC or other VC maybe trying to get into these rounds, is exactly that particular domain expertise and knowledge. Beyond that, we're very strong on financial modeling and building strong, compelling financial models for these startups and helping them to, or enable them. And last but not least, as we're like in this industry for over a decade, we're very well networked. So we have access to the funds which actually by nature do the follow-on funding. And this is just a value proposition we're doing. We build a platform going hand in hand with the community, have the domain expertise, plug this into the startups, and then build great companies which we can hand over to bigger B2B funds to be investable.
That's great. Would you describe yourself as more a Warren Buffett style of investor, leaning back, waiting for the money coming in, or more an activist investor that actively manages companies and portfolios?
Yeah, I'm a total fan of active management. Active management has a limitation. You have to pick the right founders who want to be actively managed. There's founders which have the hybris, they can do it all by themselves. They don't ask for help. I would always be a little scared to invest in them, even though they can build great companies. We will never enforce somebody to work with us if somebody's so mature and good and we can't help them. We were the first one raising our hands and stepping back. We would call it we're as active as we can be if we're allowed to be so. I think as a VC, at some point you have to be active, especially when it comes to divesting. So you have a very simple mandate. You take money from people, you invest it in the startups, and you have to return the money at some point. So at some point of time in the course of the cycle of a fund, you have to actively start thinking about divestment. So what many funds do is they hire divestment managers, people coming from PE, from public markets. We are very exposed, trying to think about how to divest the portfolio. And this will be a part side of being active in the investment period, being very active in the divestment period to kind of make sure that in time, so in the term of the fund, you can actually create liquidity for your LPs. And so I would consider myself more active than lean back. Just, there's two philosophies. Companies get bought or companies are being sold. I believe in venture capital as you have a natural limitation, time, that companies are being sold. So you actively have to proclaim to sell these companies.
What's your secret sauce then? Do you cover then the potential buyers constantly that you are in touch with potential acquisition partners?
Yeah, as I said, like we're building a very strong network, especially in PE. So we love our space in particular because of that. The natural buyer is a buy and build consolidation strategy from PEs or corporate buyouts. And as we're not depending on having like 3 billion exits on public markets, our natural exit is strategic buyer, PEs, consolidation. So we're building networks and strong strings with exactly that part of the ecosystem to have not only access to them, but actually to accelerate the selling or the acquisition process at some point. So for us, it's the same target group as our startups. They sell to SMEs, and these SMEs are the likely buyers from these companies or enterprises. And on the other hand, it's PEs, and that's where we kind of build our networks to be prepared at that point once we're like in a position to divest our portfolio.
That's great support for startups. Then they can focus on building their customer base, building their tech, and you support them then further down the road to capitalize on the assets they've built.
We hope so, at least.
I believe that. In the last 3 minutes, Marc, is there anything you would like to address?
No, we covered so many topics and so many great questions. So it would be hard to add something which is missing because there was nothing missing in my eyes, at least.
Marc, I love this conversation. You have such a great knowledge about venture investing in Europe and globally. I have a lot of questions that I could ask, but maybe we have a follow-up in 1 year or so and see what happens then in the world. I loved every single minute, and I wish you all the best for your funds, your startups, and moving forward.
Christian, it was my great pleasure. Thank you very much. I really enjoyed it. And it's incredible how fast these 2 hours kind of went through.
Time flies when you have fun.
Indeed. Thank you very much.
Marc, enjoy your afternoon. Have a great time. See you.
Bye.
Bye. In today's episode, Marc Penkala shared game-changing insights on how the best companies are born in down markets, the importance of thinking in billions rather than millions, and why being wrong more often can actually lead to higher returns in venture capital. He also reveals the contrarian strategies that set successful investors apart and the critical mindset shifts needed for European startups to truly compete on a global scale. If you found value in this episode, make sure to like, comment, and share. Your engagement helps the show grow and brings in more incredible speakers like Marc, who deliver these powerful insights for free for you, the listener. Remember, success isn't about avoiding failure. It's about learning from it, taking bold, calculated risks. The road to extraordinary achievements is often paved with setbacks, but those who persist and adapt are the ones who ultimately thrive. Keep pushing boundaries, stay curious, and think bigger. Thank you for listening, and until next time, stay motivated and keep reaching for those $1 billion goals.